Good morning, ladies and gentlemen. For those gentlemen that are joining us today, hope everyone is well this Saturday morning. I think when we initially wanted to share this session, we thought it would be a few women, and the response has been overwhelming. So we just want to thank each and every one of you that is able to join us today. Thank you so much. Thank you so much to EasyEquities, who's come on board to sponsor this. I think it would have been a nightmare if we had to send emails or inbox each and every one of you. So thank you so much. Today, I just want to go through the presentation. Okay, so today, ladies and a few gentlemen that have managed to join us, we just wanted to share the investment basics for women by women. I think, the stats have shown that not as many women are investing, and we want to change that narrative. Being an investor, an avid investor myself, and Rochelle also, we thought we'd just share a few things that we think are important for women to know about investing. So just in terms of the content for today, we'll be sharing why investing is important, understanding your risk profile. So what sort of risk profile individual are you? The different asset classes. So, you get your cash, you get crypto for those that are on the speculative side, you get property, you get equity. And we'll just go through exchange traded funds. We'll take you through a practical guide on how to screen for stocks, as well as how to, our personal experiences in terms of building our portfolio. So just a disclaimer, we're not financial advisors. What we'll be sharing is what we've learned and documenting some of the few things that we've learned along our financial journey as we've gone through this journey. So why is financial independence important for women? I think being a woman myself, I've sort of seen the importance of being financially independent. Having your own money, being able to do whatever you want with your own money. I think for me as a woman, it encourages me to know that, I can be financially independent or work towards being financially independent in how I spend my money and how I save and invest my money. So what do the statistics say? I think as women, the stats, why don't women invest? There's this thing of imposter syndrome. I think a lot of women feel, I don't know where to start. Which is why we're sharing this presentation. There's this thing of, am I equipped enough to invest? Do I know what I'm doing? And I just want to reassure everyone that, investing is not reserved for the few. It's for us women who we can do it. It's not as complicated as what we think it is. There's also a certain aspect of behavior, just not knowing what to do or where to start. There's also a real big issue of lack of funds. Now, I know I'm one person who's aware that, some women may not have that disposable income to invest. Why do women need to start investing? I think we know, ladies, I know I speak for myself. Women are underpaid. We're definitely underpaid when it comes to our male counterparts. There's always this gender pay gap, and which we're aware of, and that we just need to be cognizant of. And sometimes, when it comes to maternity leave, and I've experienced this, when we take time out to, be the caregivers, take time out to have our kids, we're penalized. Going back into the world of work after coming from maternity leave is challenging. But what I want to reassure everyone is that, or what we want to achieve today, is to show you ladies that we can do it. It's not as complicated as what we think it is. We can invest, we can start this journey, and we have what it takes to start investing. So just a little bit about myself. I know a lot of people know me from Twitter and other videos that you might have seen of me. I'm a Black female. I'm very proud of that. I love my Afro hair. I love who I am. I'm a product of parents that sacrificed to give me so much and to give me an opportunity. I always share this. When I started my first job, I'll never forget, I needed transport money to get to my workplace. And I remember my parents sacrificing their last 200 Rand to give it to me to use as transport to get to where I was going. So when I give back to, you know, my parents, my cousins who are less fortunate than I am, I'm doing it because they first invested in me. I'm a mother of two. I have two beautiful kids, a boy and a girl whom I adore and love. I'm a wife, and most importantly, I'm an investor. By investing, for me, what I look at when I'm investing, I realize that I'm trying to bridge the gap. I know where I am as a working professional, but I know that I've got obligations from, you know, my parents. I need to take care of my parents, my cousins, as well as build a financial future for my kids. So I'm literally a sandwich in between the two generations that stand in front of me. So why investing? Why do we need to invest? I think for me, it's about growing your money exponentially. If you want to preserve your money, save it. But if you want to grow and have compounding work on your behalf, you need to be investing. Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't understand it pays it. And I've just put the table for you in front of you, just to show if you had put 500 Rand, if you had put 1,000 Rand, if you had put 2,000 Rand, and if you had put 5,000 Rand, what are some of the returns that you would be expecting if your expected rate of return was 8%? In 20 years' time, you would have 286,000 if you put in 500 Rand. If you put in 1,000, you would have 572. If you put in 2,000, you'd have 1,145,320. I just wanted to highlight this table, just the importance of, you know, starting early. It doesn't matter what the amount you start off with, ladies. You can start with 100 Rand, you can start off with 200 Rand. But I think the important thing is to get compound interest working for you or on your behalf. Hence, you know, start early, start with whatever amount you have, it doesn't matter. And investing allows one to beat inflation. Saving preserves money, but investing compounds your money. And it's a great way for me personally, I've found, to create an additional income stream. You know, through dividend income, I'm able to earn a passive income on a quarterly basis. As an example, I know in May sometime, I think I earned 2,200 Rand from two of the mining companies, BHP Billiton and Sibanye, as an example, giving me income. That's extra income I received as an investor. And really, it's all about generational wealth. And I think for me, and what I'm passionate about, is this idea that, you know what, I didn't come from much, but I have an opportunity now to make an impact currently for myself in terms of my financial well-being going forward, as well as my kids, and to pass on something to my kids, which for me as a mother is very important. And I want to do that for my kids. So in terms of asset classes, there are various asset classes that we have. I know a lot of us, or for me personally, growing up, I only knew about cash, which is your savings account. And, you know, I hear sad stories of people that are saving a lot of money. You hear they're saving 10, maybe 20 or 30% of their salary on a monthly basis, but they're putting it in a savings account. And I always ask why, because saving just preserves your money. If you don't need the money in the next, you know, 24 months or the next 5 years, why not consider putting a portion of it into investing instead of just putting it in a savings account? Other asset classes includes bonds, listed bonds, or your own private company, private home, or investment property that you might have. I know EasyEquities is also one of the ways you can own fractional ownership of property. Commodities like your precious metals, like your gold, your palladium, your rhodium, equities or shares, which also includes exchange traded funds. Crypto, if you're on the speculative side, there's crypto that you can invest in, though I would encourage to keep it at a minimum of less than 4% of your investment portfolio, as well as property. So just before I go to the next slide, I just wanted to show on the right, when you look at just in terms of some of the performance of the different asset classes in South Africa. So over the last 9 months, and this graph is for February 2021, so it might have changed slightly, but I just wanted to show that different asset classes give you different returns. So the percentages you see on the right here, like for example, SA equities in under 9 months, that 32.6 is what SA equities earned over the last 9 months, as an example. So different asset classes have different returns, and it's ideal to have a different mix in your investment portfolio. Just in terms of your risk versus return, now different asset classes, like I've explained before, have different risks inherent in them, as well as return. And as an investor, you need to sort of balance the two. And I thought this was interesting, this graph, to just share with you. Sorry, ladies, I forgot one thing. We'll be running a competition throughout this whole webinar. So if I could ask you on Twitter, if you can just tweet some of the nuggets whilst I'm sharing, and the hashtag to use is female investors rise. We'll be looking to pick 10 ladies, 10 winners, to give 100 Rand vouchers each. So please tweet some nuggets that we'll be sharing during the live course of this webinar. And the hashtag is Female Investors Rise. If you can tweet your nuggets, we'll be picking out the winners. Those that get the most response on their tweet as a response will get 100 Rand EasyEquities vouchers. So please tweet during the session. I just had to remind you about that. So this graph, going back to my presentation, the risk versus return. Different asset classes have different returns. For example, when you look at this graph, I just wanted to show you that cash, as an example, is very safe. Your money is guaranteed, and you just earn interest on it when you keep it in a savings account. You can earn maybe between 2 to 6% if you're lucky, but it just preserves your money. It doesn't really grow your money. And then you have your government bonds. I think Treasury has retail bonds, or you can also get exchange traded funds as some of those bonds. There's large cap. So large cap is considered less risky compared to your small cap stocks, which is like your penny stocks, like your Avenge, your Jubilee Metals, for example, because small caps are a bit more risky. They're more volatile. Sometimes they're illiquid, which means you can't really easily sell them in the market. Whereas your large capital stocks or shares or companies usually are less risky because they're well established, they're well run, they have strong balance sheets, and they have strong cash in terms of their cash flows. And then on the more riskier side, if you're a more aggressive investor, you would look to venture capital, which is, your startups, your angel investments, where you know that this company is fairly new. It's fairly new in the market. There's a possibility that it might succeed. There's a possibility it might not succeed. So if you're a very aggressive investor, maybe venture capital might be for you. So I think as an investor, it's very important to understand your risk profile. But before I go into your risk profile, I know that you just need to be aware in terms of when you're investing. Some of the things that you need to look for is just, what am I investing into? Just understand, what is this thing that I'm investing in? How will it make me money? How will I make my money back, my investment that if I put something in this company? How will I make my money back? What are the fees that will be charged on this investment? How will I make a return? And what is the return percentage that I'll get? I think as an investor, just keep that at the back of your mind. Now, going back to understanding your risk profile, I think if you approach a financial advisor or a financial planner when working out your financial plan before you get to the investing part, they'll usually do a risk assessment to understand what type of investor are you and what is your risk profile. Are you a low risk investor? Are you medium? Are you high? What's your risk appetite? What type of investor are you? And they'll really work out to try and understand. And as I said in my previous slide, there's always this thing of risk reward. which I showed you previously. Cash just preserves your money. However, when you get into equities or government bonds, it's a bit more risky, but it has a higher return. If you look at your equities, like your large cap, MTN, for example, is a large cap. It's well established. It's been around for years. The balance sheet looks good. They're less risky compared to a Jubilee Metals, for example, which is considered a small cap. Now, my favorite topic is exchange traded funds. So I know we're all different in terms of our investment risk and our risk appetite. So I found that I know one of in terms of the FIRE movement or financial freedom, if you don't want to pick individual stocks, that's fine. But one of the ways that I find that's really good is exchange traded funds as a way, as a beginner, to start investing. One of the ways you can do that is exchange traded funds. And why I like exchange traded funds is that it's an index. I like to think of it as a basket of fruits. Consider it as a basket of fruits with different fruits in it. It's got a banana, it's got apples, it's got various fruits in it, or various companies or various indexes that it's tracking. For example, your Satrix Top 40 tracks the top 40 listed companies on the JSE, and that at least reduces your risk as an investor. So should one company, like what happened with Steinhoff, happen, there's 40 other companies that make up the basket. So you are well protected as an investor. And I know, so there are domestic and foreign ETFs that you find. There are various providers that provide this. You usually hear Satrix. I think everyone is familiar with this. CoreShares, One Invest, ABSA, Ashburton, Signia. There's a whole range of various providers that provide ETFs. And you get domestic and foreign ETFs. What I mean by that is, there's a Satrix Top 40, which is JSE listed. It's denominated in Rand and tracks the top 40 ETFs. Same as the CoreShare Top 50 Index, it tracks the top 50 JSE listed companies, which I like the CoreShare Top 50 because, it's a bit balanced compared to the Satrix Top 40, which are dominated by Naspers and Prosus. Your foreign ETFs include Signia 4IR, which tracks the fourth industrial revolution. So it's a SA ETF, but it's dollar dominated. So there's a lot of dollar-based companies that you find in this ETF, as well as the newly listed CoreShare World ETF, which I think tracks a Vanguard index in the US. So when looking at an ETF, what do I look for for me personally, what do I look for when I'm looking to buy an ETF? I usually Google them. I'm not even joking, ladies. You can go on Google and type in, for example, Satrix Top 40, and it will give you literally, there's a PDF. You look for a PDF file, you click on the PDF, and it will give you this fund fact sheet, which is a minimum disclosure document, as I've given an example here on the right. And what you really want to look for in that document is you want to look at the fees. What are the fees being charged here? And the fees, usually you'll find it under this ratio called the total expense ratio, or a total investment cost of what it costs whoever has issued this ETF to manage this fund. You look at what the ETF tracks. I've given an example of the top 40. In the top 40, there's Naspers, there's BHP Billiton, there's Richmond, there's Anglo, there's different companies in there, and there's different percentage holding of those companies in that exchange traded fund. So just keep this in mind. I just wanted to encourage you, ladies. I've put the website here. EasyEquities has got an ETFs finder as well as an ETF comparison. So you can literally take this website that I've put here, www.etfseasyequities.co.za, and use this link, and it will give you the different ETFs, the minimum disclosure document, the total investment cost, the risk profile, which really helps you understand what ETF you're buying. The other resources I like to use is ETF Central as well as ETF SA. Now, in terms of my portfolio and in putting your portfolio together, when you want to put together a portfolio for yourself, I like to use I just wanted to show you or highlight something in this table. You have to consider what overall you want to have in your portfolio, in your investment portfolio. So like I stated earlier, there's different asset classes. There's equities, there's interest bearing sort of asset classes, there's real estate, there's physical commodities, and there's cash. Now, when you're setting up your investment portfolio, you want to make sure you have each and every bit of this investment class in there. I've left out crypto, but I know there's definitely people interested in crypto. For the more, aggressive investors, you can add crypto as well, and you can decide what percentage you want to have. But basically what I wanted to highlight here is that depending on what lifestyle stage of your life you're at. For example, maybe you're starting out as a working professional. A 20-year-old would have more equities in their portfolio as opposed to cash, as an example, and other asset classes. So maybe they might have 50% invested in equities, maybe 20% in interest-bearing assets like your bonds, your retail savings bond that are offered by Treasury, or some of the, I think there's a New Funds Gavi exchange traded fund that's available. That's a bond ETF. You want to have some in listed property. There's REITs, retail investment trusts, that are listed on the JSE. And then there's also direct property. I know I previously owned an investment property that I used to manage, but no longer have. But I'd like to look at, what EasyEquities is doing, fractional ownership of a property and not directly be involved in owning a property. You can have your assets in physical properties, your precious metals like rhodium, palladium, gold, and as well as having a cash portion, part of your portfolio in cash. Now, I know my cash portion is sitting in Time Bank, as an example, and in my Access bond in my property. And the reason I have that is for emergency fund. My cash portion of my investment portfolio is in cash. And that's because I think COVID, ladies, has shown that, life is not guaranteed. We need to have some cash to at least cover 3 to 6 months of our living expenses, just to be able to absorb any financial shock that might come along in your life. So I like to have a portion in cash. I also have some in commodities like rhodium. And in terms of my portfolio, I just thought I'd share a little bit in terms of what is in my portfolio. So when you look at my portfolio, in my ZAR portfolio, for example, I have BHP Billiton, which is a diversified miner. And the reason I've gone for a diversified miner like BHP Billiton is they mine different commodities. So, if coal is down, for example, I know BHP is mining coal, they're mining copper, they're mining a whole lot. So then their shock as a miner is not impacted when one commodity is down. I like Sibanye. I think I like management, Neil Frontman, when he was doing all those acquisitions, and I could see when I did the analysis, the NAV, the share price, I could see that Sibanye, when it was trading around 30 Rand a share, I knew that it was an undervalued stock, and I started buying slowly. MTN, I am a fan of MTN. I think at one point MTN was trading at 120 Rand per share, and it dropped to 60 Rand. And I knew when it was sitting at 60 Rand, looking at their balance sheet, the cash available and what they were doing as a company, I knew 60 Rand was not a fair value reflection of what the share price should be at. So I knew 60 Rand was definitely a steal. So I bought into it. Purple Group, of course, I love EasyEquities. I use EasyEquities as an investor. They've revolutionized how retail investors can participate in the market, and I'm excited to see what the management team is doing. So I'm invested in Purple Group. In terms of my tax-free, I've gone for Satrix Top 40, tracking the top JSE listed top 40. I've gone for Signia 4IR. I just like what the fourth industrial revolution sort of includes. I know notorious Tesla. They've got a whole lot of, I like the indexes that they track, the US companies that is in this exchange traded fund. Ashburton Global 1200, I'd previously invested in this ETF, though I know now a strong contender is the new Core Shares World ETF. So looking at the total expense ratio, which I mentioned earlier, I might be looking at moving into that ETF. In terms of my USD, I'm very big on growth. So growth stocks like your Nvidia, your C, and some of your dividend stocks. Just in terms of my journey, I think we all ask ourselves, where can we start? How can we start? So I just like to share this slide with you. I think for me, it was very important to pay off my debt before I could start investing. So one of the decisions that, and I pointed out here in the green here, one of the decisions that we made as a household was that we would forego having two cars and have one car. And the money that we'd save from not having two cars, having one car, would invest aggressively because I'm 35 and we don't want to work until we're 65 to retire. We want to enjoy our money and we want to enjoy it not when we're old. We want to travel and do other things. So we want the effect of time on our side, as well as having a huge investment that can really give us income. So what we did was we started off paying off our debt. We paid off our debt aggressively. So the only debt that we have now is, like, for example, a bond and a car, and most of the other debt is paid off. So it allows us to invest, to have disposable income to invest. We have an emergency fund in place. It took us a while to build this emergency fund. It took us, I think, over a year of just consistently putting money away to make sure we build up this investment fund, emergency fund, which is 3 to 6 months of our living expenses, and just starting our investment portfolio. Because I think, if you're in your 20s, ladies, I would encourage you to start investing as soon as you can, because what you do is you have the advantage of time on your side. You give your money the opportunity to grow. And how I apply it on a monthly basis is, on a monthly basis, no matter what, we invest a minimum of 3,000 Rand. Now, ladies, you can invest with whatever amount you choose. It's totally up to you. I just chose 3,000 Rand because that's what we decided we wanted to be aggressive. But you can start with 100 Rand. You can start with 200 Rand. You can start with 300 Rand. You don't have to start with the amount I've mentioned. You can start with any amount as long as you've started. And then what we do, or some of the boundaries we've put in place, is, whenever we get money from stokvel, a side hustle, or a bonus, if you're lucky enough in this environment to get a bonus, is at least 40 to 60% of that we invest. We close our eyes and we take 40 to 60% of whatever additional income we get from a windfall, we invest it. And like I stated earlier, we share a car, which means we've been able to really save quite a bit and really invest. I want to leave you with this quote over here. You don't, as women, I think, I want to encourage us to start investing. We're underpaid. Just to recap, we're underpaid. We've got a lot against us as females, whichever race you are. We've got a lot of catching up to do. And me, for example, being in the sandwich generation where I have to take care of my parents and my cousins, as well as build for my kids, I need to ensure that I'm investing so that at least I give my money a chance to beat inflation. At least I give, my money the opportunity to grow beyond what saving can give me. And that's the difference. Saving preserves your money, your cash. Investing gives your money the opportunity to compound, grow faster, and beat inflation. Thank you.
Thank you, Esther. Everybody, can you hear me? Just drop something in the comments if you can hear me. Let me just go to the chat. Awesome. So everybody can hear me. I'm going to share my screen. Okay, so who am I? All of you, or those who follow me on Twitter, knows that I'm the one with the sharp mouth on Twitter. I am a colored female from Cape Town. I'm a regular girl, ladies. I am as normal as they come, and I say this all the time. If I can achieve a portfolio that's running close to 2 million Rand, and that was at zero a couple of years ago, anybody can do this. I'm a mom. I have one daughter. She just turned 13. I'm a wife. I've been married almost 10 years, and I'm definitely an investor. For me, I really want to leave a legacy. I think, we all come from different backgrounds, but I want to leave a legacy of helping people. I want to help people reach financial excellence. If I'm going to have to bully you into starting to save, I'm going to have to bribe you into starting to save by giving you a voucher and then getting you addicted, so be it. We have a poverty war to win in South Africa. As people of color, we started on the back foot. We do not have parents that left us investments and, trust funds, etc. So we've got a poverty war to win. We are playing catch up, and I want to play a role in people investing. I have been, while S has been on chatting, I have been looking at the comments, and I think the one comment that has been screaming at me is, where do we start as ladies, as gentlemen, who have no idea where to start? I want to today try to make it as simple as possible. I don't want to speak down to anybody. So if it is too simple for you, take what you need, leave what you don't need. But I'm going to try to make it as simple. This is how I do research. So I'm going to try to make you guys more confident and more comfortable with your choices. So Esther said earlier, we need to know the type of investors we are. You need to be honest with yourself. And also, if you are just starting out, you're not going to know what type of investor you are. You need to start. You need to make mistakes, and you are going to learn from your own mistakes. I'm trying as far as possible to not let people repeat my mistakes through my tweets, through my mentoring sessions, I'm starting a private finance school with a few ladies where we have a whole curriculum that we're going to work through. And if that takes off, I'll be rolling it out. If it's successful, I'll be rolling it out to more people. But I start by knowing the type of investor I am. I know I'm a growth investor. I have a bit of a higher risk than other people. And when we say we are growth investors, we don't say we are reckless investors. I do invest in dividend stocks. I will show you guys later the percentage of my portfolio that's in value stocks, the percentage that's in crypto, what is in there, and why are they in there. So you don't have to be one type of investor. You can be a growth investor and a dividend investor and a value investor. But what is the most important is you need to know, according to your risk appetite, what are you going to allocate to each one of those classes, in terms of, if you put 100% in crypto 2 months ago, you need to be very comfortable that you're currently sitting on a loss of, let's say, 30 to 40%. So we don't do that. We are not reckless with our hard-earned money. So I'm going to try my best to talk you guys through, and then you can decide, what type of investor you are and what you want to invest in. So where I start, I use a stock screener. So what is a stock screener? A stock screener is as simple as what you put in there. You can say, I want to invest in the JSE, then you choose South Africa. I'm going to run you guys through a practical example later, but a stock screener it gives you options so that you don't feel lost. So if you say, I want to invest in the JSE, I want to invest in companies that's in the mining sector, and I want to invest, let's say, in companies that pays a dividend of 5%. And then the stock screener will give you a selection of shares that fits your criteria. And then when you get to that list, I'm also going to show you, once you get to the list, now what? Because then your research starts, okay? So how do we do research, okay? A company has an income statement, a balance sheet, and a cash flow statement. Those are the financial statements. Companies can add a lot more statements if they want to. There's a lot of notes to the financial statements. It's all blah, blah. It's literally just there for, it's we call it IFRS compliance, so financial reporting standards. There's a lot of information just to vouch for the numbers that's on the income statement, balance sheet, and cash flow. And if you are a financial person, sure, look at those notes. If a company, for instance, has their revenue and you want to see how much of the revenue comes from South Africa, how much of the revenue comes from overseas, you're welcome. It's all there in the financial statements. But if you are just interested in the revenue number, you just need to know how to read an income statement. Equally on the balance sheet, if you just want to know how much assets a company has, just go there, look at total assets and leave. If you want to know if the company is in debt, go there, see how much debt there is, compare the debt to the cash or to the money that the shareholders put in. And if the shareholders put in the same amount as the debt, you're like, but this is too high. You know, what is this company doing with our money? So I'm going to talk you guys through, once you find a stock, what do you do practically? So the first thing I'm going to check through is revenue, okay? This is the heart and soul of any business. Unless a business is a non-profit organization that doesn't have revenue, any business starts with revenue. So revenue is as simple as we put it, it's the sales of the business, okay? So that number is very important. And also, remember now, in a business that's established, let's say like Walmart or Amazon, the revenue is going to be very stable. In a business that's brand new, the revenue is going to be very unstable. So that is where your risk appetite comes in. So if we look at, if you see the revenue number in a company, then you're like, so, but what must I do with this number? You need to compare that number to the previous year. That's the first thing that you do. We do not invest in companies with declining revenue. Now, okay, you can maybe see, you know, COVID was, it's a once in a millennium or once in a blue moon situation. We don't judge companies that have, you know, bad revenue in a year like this. But if it's a normal year, I expect the companies that I invest in to grow their revenue year on year. I also compare my revenue to the industry. So how do I do that? If I can't compare BHP to Pick n Pay's revenue, that doesn't make any sense. I need to compare Pick n Pay to ShopRite, or I need to compare Woolies to Pick n Pay. So, and then I look at the percentage increase in Woolies and the percentage increase in ShopRite. So let's say my stock screener, I say I want to invest in retail, and then the stock screener gives me ShopRite, Pick n Pay, Woolies, Spar. Now you're asking me, you know, then when I go to the financial statements, I'm going to look at the revenue for each one of those, and I'm going to compare the growth. So I don't compare the cold number. If Woolies revenue is $1 billion and Pick n Pay's revenue is 500 million, I will compare the growth of Pick n Pay to the growth of Woolies year on year. And then if you are an investor in the US, I've just put point number 3 because I am an investor in the US, ladies. In the US, every quarter, you will see that we start getting excited on Twitter about earnings season. What that means is every 3 months, so end of March, end of June, end of September, and end of December, every single company in the United States have to issue their quarterly results. So what the companies do, and in the US, this is very important, they have to put out estimates. So it's a forecast, a guess. So they have to guess what their revenue is going to be every quarter. And they can't just guess a random number. There are rules for how you guess the number. So if they guess, they're going to increase their revenue by 20%. And they followed all the rules and they crush those numbers and they come out with, let's say, 35% increase in revenue. You can be sure that stock is going to rip after earnings season. So that's why you see people getting excited about earnings season, okay? And also on the flip side, if they said they're going to increase revenues by 20% and then they come out and they've only increased revenues by 8% or 12%, that stock is going to crash. So estimates are very, very important if you invest in US stocks, not so important in South Africa because we don't put out estimates in South Africa. Where do I find this information? There's two options. I have a preference for a company's financial statements, and I'm going to tell you guys that later, okay, when I get to what resources I use. But there is that's my first choice because that is going straight to the horse's mouth. Okay, my second choice is a website called Ticker. Ticker has all stocks of the whole world. They collate all companies' financial information, and it's really the easiest way. They will have the balance sheet, the income statement. Let me actually show you guys on the next. So what I did was I went and I searched for the financial statement, so the income statement of Avenge. Okay, so Avenge, what I did was I looked at the revenue line. So if you now look at this, if you look at a company's financials, it's not going to give you the year-on-year percentage. So Ticker actually makes it very easy. They already calculated these ratios for you. So you can see Avenge increased their revenue in 2018 by 72%, then it crashed in 2019 by 18%, and now Avenge has increased their revenue again. June 2020 was the last time they issued numbers, was 4.7%. So you're looking at this number cold. The number means nothing to you. It should mean nothing to you. You have now compared, the only positive that you know is Avenge has grown from last year. Now you need to go compare Avenge to the industry. Who's Avenge? Who is in the same industry as Avenge? What I do is I would most likely take Murray and Roberts, and I would say, okay, Avenge increased by 4.7. They play in the same space as Murray and Roberts. What did Murray and Roberts increase their revenue by? So then I go and look at Murray and Roberts. I would do the same thing here on Ticker, and I would go to Murray and Roberts and I say, Murray and Roberts increased their revenue, let's just make an example, by 30%. So what is wrong with Avenge? Or Murray and Roberts has actually lost revenue. They have a minus 10%. So Avenge is doing something right. That's how you compare year on year, and you compare to industry and competitors. Okay. The next item in the income statement. So we are talking through the income statement now. We're going to look at revenue. We're going to look at the gross profit and the net profit. Okay, that's the only items in the income statement that you need to be worried about. So the gross profit is, in simple words, in simple English, is a product profitable without taking all the fancy expenses into account, like salaries and marketing and legal and all of those things and rent, etc. The product, if you're making bread, all the ingredients for bread, just those ingredients, bread sells for 13 Rand, the ingredients cost 10 Rand. Yes, bread is profitable. That's the gross profit. Okay. If a company makes a loss at gross profit level, run. They are doing something seriously wrong. You run the other way. We don't invest in companies with a negative GP. Okay. Net profit is now, okay, salaries, rent, legal expenses, all the fancy things. And then we see what is now left for the shareholders. That's the net profit. So your dividends that you get, that gets paid out of the net profit. And then obviously, either they pay it to the shareholders or they reinvest it back into the business, but we'll get to dividends just now. Again, when you get these numbers, what do you do with it? I've taken Avenge, again, the same slide that we had earlier. Avenge, the change year on year for the gross profit is 12%. And then if we look at the net profit, right at the bottom, Avenge increased their net profit by almost 46%. But if we just look up above that 46%, Avenge is making a loss, which means Avenge has just made a smaller loss, but they're still making a loss. Now, what I do is I look, when a company is loss making, I don't run. At GP level, yes, I'm gone. If your product can't make a profit on its own, I don't even know how you're going to pay salaries. So when we get to the net profit line, what do? We like, is this company growing? Are they spending a lot of money on maybe research and development? Is there a reason for the loss? If the reason for the loss is simply they don't know how to manage a business, then I don't invest in it. If there's a reason they're spending a lot on, they have to expand, they have to move businesses overseas or bring businesses back home, and that's where research comes in. You can't just look at these numbers cold and say, Avenge is making a loss, I'm walking away. Avenge made a smaller loss, but now we need to go and see, why is the company loss making, and are we willing to give management a chance to turn this business around? So that's how you look at the income statement of any business. Okay, I just wanted to give you guys an example of a US growth stock and its balance and its income statement. So how we define a growth stock, and it's very, it's very arbitrary. Some people say if their revenue grows by more than 30%, others are very aggressive and they say if the revenue grows by more than 50%, it's a growth stock. So Upstart is a company that I'm very bullish on, that is probably in my top 5 growth stocks. And this Upstart is a company that collects data points, artificial intelligence. So what Upstart has been doing for the past 13 years, they have been collecting data on all American consumers in terms of every time you swipe your credit card, every time you draw money, every time you buy something, you rent an apartment. So they have over 34 billion data points that they have collected over the past 13 years on the American consumers, and they can tell. Their software can tell with 99.999% accuracy if you are going to be able to repay your loan. So it's so much more than a credit score. It's actually beautiful. It's artificial intelligence. So what Upstart is doing, they sell the software to banks in America. Okay, and if you can look in 2017, you will see that there's not an increase in revenue figure because it's a new business. They were collecting the data points and they only launched the business years after. So this is a new company, high risk but potentially high reward. So Upstart increased their revenue by 26% in 2020. There's a very nice website called earningswhispers.com. So what Earnings Whispers does, remember I said earlier that in America, they issue these quarterly revenue and gross profit margins, etc. So Earnings Whisper collects all that data, and then what they do is they compare. So when the company comes out, they compare, did the company meet that target? So it's a nice place to get all those estimates. So Upstart is saying, so what Upstart has told the market, and it's on Earnings Whisper, that they are going to increase their revenue by 158% from 2020 to 2021. If they beat that estimate, which is, from my reading, it seems like they're gonna beat that estimate. If they beat that estimate, the share price is gonna rip. If they miss that estimate, the share price is gonna crash. Because what a lot of people don't understand, and I think if you take nothing away from what I'm saying today, just this one thing: markets are forward-looking. As soon as a company says something, the market prices that statement in. So when a company, so let's say RMH, which I know a lot of people FOMO'd into, if RMH says we are going to declare a dividend of 10 Rand, the next day, when the market opens, the share price goes up by 10 Rand because the market prices that that dividend in. So the market has already priced in this 158%. So you can't go buy Upstart now and think it's going to increase by 158 and the share price is going to rip. If Upstart meets that 158, the market has already priced it in. It's only if they beat that estimate that you will see the share price rip. So if you take nothing away from today that I'm saying, just this thing, markets are forward looking. You cannot buy a dividend because the share price has gone up. You can literally look from the time a dividend is announced to the time that it's paid, and then immediately after it's paid, the dividend drops. I'm going to explain to you guys why that happens. Then I'm not going to go into this with a lot of detail because I know this is a basic session, but there are two ratios that people are always talking about. And I think it confuses a lot of people. It is the price to sales and the price earnings. So these ratios, all they do is they tell you whether a stock is expensive or whether a stock is cheap compared to its peers. Okay? All it means in simple terms, you never need to know how to calculate this ratio. I promise you, any website that you go to has already calculated it for you. If you go to ticker.com, these ratios have been calculated for you. So understanding how to calculate it and sitting with a calculator is not going to help you. So all it means is if you pay 10 Rand for a share and the price to sales ratio is 2, it means it's going to take 2 years to get your share price back in terms of sales. So if the company does let's say they do sales of 5 Rand, and you pay 10 Rand, then it's going to take you 2 years to get your share price back in terms of sales, and not in your pocket, in terms of the market. Okay, the same with price to earnings. Earnings is the net profit we talked about earlier. That's why you will see some companies have a negative PE ratio. And why they have a negative PE ratio is because they're making a loss. So if you're looking at PE ratios, it's how long is it going to take you in terms of earnings, net profit, to get your share price back. So if the PE is 10, it's going to take you 10 years to get your price back in terms of earnings. This is how we determine if a stock is cheap or if it's expensive. So we always want these numbers to be as low as possible. And again, as I said, you need to compare them to their peers. You cannot compare a PE for BHP to a PE for let's say Lewis or Pick and Pay. You can't do that. You need to compare them to their peers because companies have different. That's how you will determine if a stock is expensive or if it's cheap. Okay, and then it's also it was unheard of in the past, and that's why I made it red. It was unheard of in the past to compare PEs for different geographies. Okay, they would always tell you in school that the USA has different PEs to South Africa. But I'm starting to think that geographies are becoming less and less important. If I'm, for instance, looking at Amazon and I'm looking at Coupang. So Coupang is in South Korea and Amazon is probably all over the world. I want Coupang to have a similar PE to Amazon. So geographies are becoming blurred with how the world is trading. So in simple words, it's just how many years it takes to get your money, your share price back. That's all it is. Dividends, everybody's favorite. So what are dividends? It's just a piece of the profits of the company that you invested in, as simple as that. It's nothing more, nothing less. We complicate it unnecessarily. And why do companies do this? Why would you give your shareholders a dividend? Shareholders need to share in the profits of a company. Okay, if a company cannot sit on too much cash if they are not growing, the shareholders will vote that management out. Okay, and then dividends are a beautiful way of attracting investors, new investors, because they are a very, very recognized category of investors that are investing for passive income, as Esther explained earlier, and you cannot disrespect that part of the market. And then why are there companies like Amazon that just refuses to pay dividends? So companies that don't pay dividends, generally, they reinvest the money back into the company, which will make the share price go up. So that is exactly why Amazon doesn't pay a dividend, as Jeff Bezos is very, very clear about that he's taking his shareholders' money and he's making them more money with their own money. So if you look at how the Amazon share price has gone, I think I bought Amazon, ladies, for $1,700, $1,800 in 2019 or something. And I think my Amazon stock price is now at $3,500. So I haven't received a single dividend from Amazon, but my share price has gone up almost double. So I'm okay with Mr. Bezos using my money and making me more money, babies. I do have dividend stocks, and they have not grown as fast as Amazon, but they pay me a solid dividend. So I'm okay with that, ladies. Then a lot of people have asked me on Twitter, what on earth is ex-dividend date? Because they see this, they don't understand it. It is very, very simple. The ex-div date and the LDR is the same date, okay? So as I said earlier, I'm going to make this very simple. A company declares a dividend, okay? The day they declare the dividend, the share price starts trading, including that dividend. We call it cum dividend. It's not what you don't see it often in, like on Twitter, etc. But the share price starts trading, and cum literally means including the dividend. And that's why I'm telling you the share price will jump with the dividend. So if the dividend is R1 per share, the share price will go up by R1. If the dividend is R2 per share, the share price will go up by R2. So then the share price trades cum div at the higher share price, including the dividend. Then you have an ex-div. So that's the day when the markets close on ex-div day. You need to own that share. So if they declare the dividend, let's say on the 1st of January, ex-div day is 15 January. So then the share price trades at that higher price up until ex-div day. If you own the share on that day when the markets close, you will get the dividend, okay? Whether you bought it before 1 January or whenever, you'll get the share. All the shareholders in the books will get the share that day. The next day, the morning you wake up, the share price drops with the dividend share, with the dividend amount. The very, very next day, it starts trading ex-div. So it starts trading ex-div, and it means excluding the dividend until the dividend is paid. Okay, and then life just goes on normal until. So the only date you need to remember is ex-div day. So if the company declares a dividend and you feel in that 15 days or 20 days, I want to pay the higher price because I want the dividend, you're going to lose that. You're going to get your dividend, and then your share price is going to go down, and then EasyEquities is going to show on the screen that you are actually in a loss position. But you're not in a loss position because you got the dividend and you forget about the dividend. So that's how ex-div works. And then we have two ratios. The dividend payout ratio, it's a very easy ratio. It's just the percentage of the profits that they give you. So it's just if the company makes R100 profit, and they have a 10% payout ratio, then they're paying out R10 to the shareholders, and all the shareholders will share that R10. The dividend yield is probably the more important one. The yield is the percentage that you will get. Okay, so you can look at dividends in two ways. You can say, I have 100 shares, and they're saying they're going to give me R1 per share. Okay, or you can look at it, I own 100%, 100 rands worth of shares, and the dividend yield is 10%, so I'm going to get 10 rand. It's really basic. So the dividend yield, you can find it on Google, on any share. I will show you guys where to find the dividend yield for any share, and you can compare them even and see which one you want to invest in. So then I spoke so much now about the income statement, but that's the income statement. You look at revenue, you look at gross profit, you look at net profit, and then there's a few ratios on the income statement, which is your PE ratio and your price to sales, and then your dividend, okay? Then the balance sheet, I just have this one slide. All I look at on a balance sheet of any company that I want to invest in, I want to see, does this company have cash, and does this company have debt? I'm really not interested in anything else on a balance sheet. I look at how much cash do they have, how much debt do they have. I don't want to invest in companies that are over indebted. And when I say over indebted, you don't compare the debt to the cash. What you do is you compare the debt to what shareholders put into the company. That is called equity. With the money that the shareholders put in is equity, ladies. So you always compare. You don't want to invest in a company that has more debt than what the shareholders put in. I actually have a rule. I don't invest in companies that have more than 50% debt. So if I put in 100 Rand, I don't want my company to have 52 Rands worth of debt. So it needs to be lower than 50%. That's my rule. Some people are okay with investing, like up to 100%. I know most investors get very, very uncomfortable over 100%. So we almost play. The lower the debt is, the better, because debt eats into profits because the interest rates are high. So that's why when you see, in the US specifically, also in South Africa, when interest rates change, the stock market goes bonkers. Why is that? Because companies have debt on their balance sheets. And as soon as the Reserve Bank increases the interest rate, we already know that Absa is going to have to pay like 500 million or 1 billion Rand more in interest. It eats into your share price. So that's why it's very important that a company doesn't have too much debt, because then interest rates wreaks havoc with your investment. Okay, I also don't want to invest in established businesses, ladies. So if I invest in ShopRite, which is an old company or old mutual, they cannot have negative cash flow. And when I say negative cash flow, what I mean is a cash flow statement is just this: all the money that came in, the cash, and all the money that went out. I want that bottom number to be a positive number in a cash flow statement. That's all it is. So I don't want my companies to be cash flow negative if they are established businesses. It literally means management doesn't know what they're doing. A business cannot be eating into cash, okay? And then unless they are in the growth phase, that is very important when a company is setting up. So if you're investing in a startup or in a company that's in its first 10 years, I don't mind negative cash flow, because I know they have to invest a lot into property, plant, and equipment. They're spending a lot of money on research and development. So there are instances where it's forgivable for a company to be cash flow negative or to be eating into cash flow. If a company is cash flow negative, the chances are very, very good, ladies, that they need to go and borrow money at some point in time. So if a company keeps on eating into cash, they eventually have to go and borrow money. And then the last one, if a company uses debt, if they go to Absa to borrow money to pay me a dividend, I cash in and I walk away, because management they don't know what they're doing. You cannot use debt. Then rather tell your shareholders, be a responsible business. Tell your shareholders there is no money for dividends, but you cannot put this fake image out to the market that you keep on paying dividends, but in the meantime, you're running up debt on the side and eating into our profits. So I don't invest in companies. Practically, if I see a company has used debt to pay a dividend, that's my last dividend from them, and I walk away. So just in terms of the balance sheet, let me tell you guys what I see on Avenger's balance sheet. So we were looking at the cash. I told you I look at the cash. Avenger sitting on 1.7 billion rands worth of cash. That's a solid cash balance. Then I look at the debt, which I've highlighted. The debt, they're sitting on around 1.9 billion worth of debt, which doesn't look bad, okay? But remember, I told you guys that I don't invest in companies that have more debt than what I put into the company. And if you look at the total equity line, that total equity is the money that we put into Avenge, us as shareholders. All the shareholders, retail investors and institutional investors. So we put in 1.8 billion and Avenge has debt of 1.8 billion. The chances are, if I'm doing my DD on Avenge, I would most probably not, if I'm looking at the balance sheet, invest in this company. I would most probably wait for them to repay some of that debt. What some other people do, hey, they take the debt and they minus the cash from it, and then they look at what is left and compare it to the equity, and they would obviously then come to a very different conclusion than I have made right now, because they will say 1.8 billion in debt, 1.7 billion in cash. If we look at it, this company is sitting with 100 million worth of debt, and they have 1.8 billion, solid company, they invest. It's how you look at it. So there isn't a right or a wrong answer. But when I'm looking at a balance sheet, I look at cash, I look at debt, and I compare it to the money that I put into the company. Okay. And then I'm quickly just going to talk about management. People, if there are any shady characters on a management team, you walk away. If you guys ask me today, so would you invest in Steinhoff? No, some of the rot is still in that company, so I'm not going to invest in it. But that is my opinion, okay? Anybody that's invested in Steinhoff that likes the company, that thinks they got rid of all the rot and that management is amazing, I totally respect your view. But I like personally, I just don't think these other companies, I'm not going to take that risk. So I ask myself, who's on the management team? How long have they been there? When I'm looking at growth companies, so brand new companies, I want the founders to be there, because I want to invest alongside the people that have something to lose. So the founders are normally the most passionate people about this company, and they're going to make it work. So if the founders are still involved, and that's growth companies, you cannot expect Old Mutual's founders to be here after 180 years. So growth companies, we look at, are the founders still there? So I love that Upstart's founders are still there, Palantir's founders are still there, Celsius founders are still there. So those companies are definitely on my list. And then I look at how management is compensated. So if management is compensated based on performance, I'm happy. So I think Naspers, or one of those ones, issued yesterday that they made 83 billion in profits, and the CEO earned 247 million. I'm okay giving him his 247 million. Sounds excessive, but he made us 83 billion. So it's based on performance. If management if they made a loss and they still gave him 247 million, I would not be okay as a shareholder, and I would most probably voice my anger at the shareholders meeting. So if you guys are not attending shareholders meetings, if you are investors in any company, you are now with COVID and shareholders meetings are online, you should start attending those meetings. Okay, then what I want to do quickly is I want to just take you guys through an example of the stock screener. Okay, just let me know when you guys can see my screen. Just want to share my screen again. Yahoo stock screener. Okay. Okay. Esther, can you just let me know if you can see my second screen, the Yahoo screener?
So I can
Before
see
I
it.
Can you see it? So I can take the ladies through it. Thank you so much. So ladies and gents, sorry that I keep on saying just ladies. If you go to Google, I'm going to take you through a practical example of a stock screener. So let's say I'm an investor. So I go in, I just Google Yahoo stock screener, and I want to do a new screen. Okay, so I'm going to click on new screen, and let's say then you get to the screen. Okay, it has a lot of information, but here's your screener. So now you need to know what you are looking for. Okay, I'm going to look for a company in South Africa. Okay, I'm going to look for South Africa. I want to bring it back home for our JSE investors. Now what the screen is telling you, there's 453 companies listed in South Africa. Too many. We need filters. My portfolio is currently short of mining stocks. Okay, so I'm going to say I want to go to basic materials, which is another name for mining. Now it's telling me in South Africa, there's 42 companies, mining companies. Okay, now I don't care what kind of mining companies it is. You can go and put a filter if you're looking for copper or gold or platinum or silver. You can do that, but I'm not really worried. I've got another filter I wanna try. I want companies, and as I told you, I'm gonna type in your revenue. So I told you guys earlier, growth stocks are companies that grows their revenue by more than 30%. Okay, some people say 50, some people say 30. I want companies that grows their revenue. Let's be greedy. Okay, let's say we want companies that, so now it has brought this filter in for you, your 1 year change in revenue. I want it to be bigger than 50%. I'm that greedy. So now it tells me there's only 6 mining companies in South Africa that's growing their revenue by more than 50% a year. Let's see which companies it is. So now it's telling us it's Impala, it's Sibanye, it's Northam, Royal Bafokeng, Alphaman, and Jubilee. Okay, we're not going to invest in all of these companies. Let's be a little bit more greedy. Let's say we also want a dividend. So now we type in here dividend. And we say we want, so you don't want the dividend per share, etc. You want the forward dividend yield. Remember, I told you guys the dividend yield is the percentage that you get. Okay, so I want mining companies in South Africa growing more than 50%, and they must give me a dividend of more than 5% a year. Now it's telling me there's only 3 left out of your 6. Okay, now I get there and it's telling me only Impala, Sibanye, and Royal Bafokeng adheres to your strict filter. So now I get, yeah, I don't want to invest in all of them. I only have 500 Rand. I can't invest in all of them. I don't want to split my money. Now comes the research. So now I'm going to click on Impala, and I'm just going to open it in another screen, open in a new tab so that you guys can see. So you come up on the screen, it tells you that's the share price. It fell like this on Friday. You can see here the dividend yield is 5.81%. That's why it met our strict criteria. You can also, so you'll see there's a whole lot of tabs here at the top. It has a lot of information for you. You saw the stock ticker, the ticker that I did earlier. You can get the same on Yahoo. Can you see here's Impala's income statement? There's Impala's balance sheet. There's Impala's cash flow statement. Okay, so you can, all the information is here. But what I like the most is where I start is not there. I start here. This is gold for me. This is all the news everywhere where Impala has been mentioned in the news in the past forever. You can go back as far as you want. Because this is a free stock screener, my apologies, because you will just need to skip the ads, okay? You can see there's an ad for UCT, just skip it. So you can now see Impala was there. Is Impala Platinum stock outpacing its basic materials peers this year? I would go and read that. I can say here it says that which stock is a better value option. And then here it says, so everywhere in these articles, you will see that Impala is mentioned in this article. So you can even see here, is Impala outperforming? So you just need to go. So this is where I would start. If there is any bad news here or something about management, I don't even go further. Then what I normally do is, and this is what I wanted to tell you guys, is I would go and copy this. I copy it and I take a new tab and I paste it in Google. I want to go to the company's website. Now, who are you to the company? You will see there's Impala. You are not looking for a job. You don't want to contact Impala. You are an investor in Impala. So you go to the investor section of Impala's website. This is the most beautiful and up-to-date part of any company. So what you do is you take any company's name and you just add the word investors next to it, or investor relations, and it will bring you to this page. So this is everything that Impala wants to tell their shareholders. There is an investor pack, which is probably a welcome pack here. There's a webcast, there's some results, financial results, there's presentations. Everything that you will ever need for your research is here. Now, you will most probably not, the only thing you will not find, so everything on the investor section is vetted. Everything that goes on here has gone through the JSE to be put on here. So you can trust this information. But what you won't find that is beautiful is the news articles and other people's opinions of Impala. Because remember now, this is what the company is telling you. This is what the market is telling you, and you need to bring the two together. So this is how I would go and look at each one of these companies. Even for Impala, I'll do the same for Sibanye, I'll do the same for Royal Bafokeng, and then I look at the revenue, the gross profit, the net profit, I look at the dividend yield if it's important to me, I look at the PE ratio compared to the industry, I look at, is this company over indebted? So I would then compare my three that was here. I'll draw up a little spreadsheet. I put all my things in the spreadsheet, and at the end of the day, I decide, okay, I'm going with Sibanye. Okay, so or I decide I'm going with Royal Bafokeng, or I decide I'm going with none of them. Let me go and change my. I've changed my mind. Maybe I don't want a dividend because the ones paying a dividend, as you know, maybe has some other factors. So you need to be able to play between a stock screener, the news, and the company's investor section. And I promise you, if you look here, I mean, this investor pack is a pack specially prepared for investors. I promise you, there's probably videos in here. There's probably presentations in here, forecasts, etc., etc. The company telling you if they have any plans to expand. Everything is here for investors to look at. So you don't have to be uncomfortable when you are investing in the company because all the information is there. You can get a stock, you know, you can get a idea or a suggestion from Twitter. Bring it here. Come back to what the company is telling you. Go to the news and then decide how you are going to proceed with your hard-earned money. Don't FOMO into things because you could be coming here into the news and there's an article of a major competitor for Impala that's going to disrupt them completely. And then no amount of the company's website is going to make me invest in it if I think that competitor is going to ruin Impala. So you need to be able to bring the two together and make an informed decision of what you're going to be doing with your money. Okay, so these two slides basically just speaks to what I just showed you guys on it. I have the results there, and then I obviously have the results there, but I've talked you guys through the the actual stock screener. Then a lot of people, I'm not going to go into too much detail here. These slides are going to be available. I'll also post it on my Twitter, you know, all the resources that I use. These are my most important resources. So I've already talked you guys through the investor section on any company's website. That's where I start. I combine it with my Yahoo, CNN Money, investing.com Substacks. That's where people write about stocks. I subscribe to a lot of them, and I subscribe to them, and then I add my own research on top of Substacks. StockTwits is just what it says. It's a room, it's chat rooms. It's really fun Twitter talking about stocks in a controlled environment. You can go and ask people questions there, what they think about a certain stock. People are very willing to share. Then for South African shares, I really like SA Shares and TradingView. Seeking Alpha, just be careful. Anybody can write for Seeking Alpha. You can literally have a Bitcoin article that says Bitcoin is going to 50,000, and the next article, Bitcoin is going to 10,000. So Seeking Alpha, you have to build up a trust with certain writers. And then the Motley Fool I use for value investing, and then Udemy and Gumroad I use to do courses and to educate myself on different skills that I think I need to invest and to grow my money. So that's the resources. I will post a list for you guys. Just in terms of my portfolio, I wanted to, sorry, my value stocks are 20%. I just see I made a mistake now. My JSE stocks is 20% of my total portfolio. Okay, these are the companies that's my top 5. I feel very passionate about. Is Exaro, BHP, Lewis, PPE, and Kumba. I've been in all of them for quite a while. I'm still adding to Lewis. I think the company is undervalued, but again, that's just my opinion. And then my value stocks is also 20% of my portfolio. My biggest ones are Apple, Microsoft, Amazon, Bank of America, and Nike. I think the only one that doesn't pay divvies is Amazon. So they almost qualify as divvy stocks too, okay? Except for Amazon, they don't pay dividends. Then my growth stocks, I told you guys earlier, I'm really a growth stock investor, but it doesn't mean I ignore my JSE stocks and my value stocks. Okay, so in my growth stocks, I've got Dermtech. We all know Dermtech. It's the one for skin cancer. So what Dermtech does is they have a smart patch. So instead of, if you have a mole or something on your skin and you go to the dermatologist, so instead of them cutting it out and sending it to the lab, and then it comes back and you find out it's not cancer, but you have an ugly scar, just to do that, Dermtech has developed a smart patch that you wear, and then after a few days you go back to the dermatologist, he removes the smart patch, he sends it to the lab, 100% accuracy to tell if you have cancer or not without taking a piece of your skin. Futu, this is the company that sometimes I, in my head, compare PPE to. It's the company that I want PPE to grow into when they are grown up. So Futu is a Chinese company. They are called the Robin Hood of China. So if you know Robin Hood is like how we buy stocks on EasyEquities, but they also have options, etc. So it's really, really advanced. Futu also, what they do on top of it, they do wealth management. They're going into insurance, and then because China has banned crypto, Futu is very popular in Singapore, Malaysia, and the US. So they're going into crypto, into those markets. Futu has the most beautiful set of financials I've ever seen. This company has zero debt, and they are growing at around 60 to 70% a year in revenue and in gross profits. And then Intrusion, Intrusion is they develop software. So Shield is their latest product. It is cybersecurity. Then Celsius is a beverage company. They make energy burning drinks. It's mostly marketed at the fitness market. They currently, why I love Celsius is apparently it tastes awesome. That's the one part, and they are really, really growing. They currently only in the US. They going into Canada in from next month or the month after that, and then I'm hoping they're going to take over the world. So I am in Celsius for the long haul. And then Upstart, I chatted to you guys earlier. Then 10% of my portfolio is crypto. Everybody knows Sol is bullish on Ethereum. I am bullish on Ethereum because I actually think Ethereum is more valuable than Bitcoin. That is also just my opinion. I could be wrong, but I buy Ethereum every single month. Bitcoin, I have now moved my Bitcoin to buying Bitcoin weekly. So I've got a 500 Rand debit order that goes off every Wednesday, and I buy Bitcoin. I don't even think about it. I don't even see it. It's gone every Wednesday. And ValR does the purchase on my behalf. And then Cardano, Ripple, and Binance Coin, those are my altcoins. I like the technology behind all of the coins. So these really make me, my crypto portfolio makes me happy and sad, within minutes of each other. So with my personality, I think I need crypto. If you cannot handle pullbacks of 30 to 40%, please stay away from crypto, ladies. You will get heart attacks. So now I'm really going to go basic, guys. There's a lot of people that have asked, how do I've downloaded the app. What do I do now? And I'm going to try my utmost best to keep it as simple as possible. EasyEquities is just what they promise. It's easy. It's not complicated. I know some people feel overwhelmed when they, I'm going to have to log in again. When I know some people feel overwhelmed when they go to the platform, but it is really easy. You just need to navigate yourself. So when you go into EasyEquities, okay, you get to the screen. Everybody's screen looks like this. The most important things that you see on the screen, you're going to have your ZAR account, you're going to have your tax-free, you're going to have your dollar account, your demos. If you don't see, and this is one of the first things I quickly want to touch on, people have asked me in my DMs, so I can't see my dollar account or I can't see my tax-free. If you go, so on both sides of EasyEquities, on the screen, if you are on the website, there is a drop-down list on this side, okay? And there's a drop-down list on this side. This drop-down on this side is personal, okay? Just think about it that way. It's a very personal drop down. The drop down on this side is how you're going to navigate EasyEquities. If you want to deposit money, if you want to do a transfer, if you want to buy some easy credits, if you want to withdraw money back into your bank account, this is where you're going to do it. This side is, so everybody goes there. Yours, this side is personal for you. So it's my Thrive, my profile, my tax information, my identity. So if you don't see one of your accounts, just go to account management. It's literally as simple. EasyEquities made it this simple for us. You go to account management because you're looking for an account. You say, manage my existing accounts. And then here you see all your accounts. So you can switch accounts on or off. So if I switch the demo USD off, it's now gone. I switch it back on, it comes back. So if you can't see one of your accounts, ladies, it's probably that it was ticked off. Okay, so now the demo ZAR has disappeared. So that's how you do that. If there is an EasyEquities Academy. I've looked at some of the videos in here. So if you want to on this side go to the EasyEquities Academy, you can get some nice points which you can use for your fees. It will educate you and in the same time earn you points. Then the other thing, just on this side, I wanted to show you guys the account management and your account preferences. So this is very, very important. Remember, I said this side is personal. Okay, so now it's asking you, how do you want to transact? Okay. So remember, if you put in on EasyEquities, so if it says, the amount, so if by buying amount excludes transaction fees, okay? So if you put in, you only have 100 Rand in your EasyEquities account, now you put in 100 Rand, but you don't have enough for the fees. Then don't choose this option, choose this option. So if you put in 100 Rand, so in this option, it will come to 101 Rand 50 maybe, okay? In this option, if you put in 100 Rand, you're going to get maybe 99 Rands worth of shares, and the 1 Rand goes to, so they're only going to take 100. So you don't have to guess the fee to get to the right amount. Then your dividends, this is also very important. If you want your dividends to be paid out to you in cash, you choose the first option. You can see it's defaulting there, okay? If you want to automatically reinvest your dividends into the same company, then you choose the second option. Then you don't have to do anything. EasyEquities is going to do it for you. Okay. I personally, ladies, I don't like the second option. And my reasoning is, what if my dividend paying share is trading at an all-time high? I don't buy high. So I want my dividend paid to me. And if I want to take my Kumba dividend and go and buy PPE with it, I want that option. I don't want EasyEquities to reinvest for me. Other people are completely different. They want EasyEquities to reinvest their dividends for them, and that is completely okay. That's up to them. Okay, and then this is just the order types. So this is new actually. On EasyEquities, where you can put so let's say you're buying a share, so if you just use the default, it defaults to the default. So the price you see on EasyEquities is maybe 24 Rand, and then when you execute, you see the price is 25 Rand. Because EasyEquities is 15 minutes delayed. The prices that you see is 15 minutes delayed. But when you execute, you always execute at the live price on the JSE. That I can promise you. I have double checked it. I've had EasyEquities open. I have my Google open with my shares. It always executes at the live price plus the spread. Okay. The option that EasyEquities have now given us is, if you do basic orders, it's where you can say, the price I see in front of me is 24 Rand. If this executes, I don't want it to be more than 25 Rand. Because I'm saying 25, it must be 25. So if you choose the second option, be very careful if you choose the second option, because if you do that, then yes, you mitigate your risk of paying a higher price, but you need to wait, because remember now EasyEquities can't execute. If the price is trading at 27, 28, your order is just going to sit there until it gets to 25. So if you're okay with waiting, then EasyEquities will execute it when it's at 24 and 90. Okay, that is that side. And then when we go to this side, which is everything, it's really just, how to navigate EasyEquities. So you can see there's the account overview, there's your new listings. If there's new companies that list on the JSE, it will go up there. If you have your investments, I'm going to take you guys to this section up there. And then this is very important. So if you go on this drop down and you go to deposits, it's very important. This is your EasyEquities. This is what you put on your bank account. Okay, so if you bank with Absa, you choose Absa. If you bank with FNB, you choose the FNB banking details. If you bank with Standard Bank, you choose the Standard Bank, because then you don't want to be transferring from Absa to EasyEquities, but you bank with, you bank with FNB. So now you're transferring to Absa. Now you have to wait 2 days for your money. So EasyEquities has made it extremely simple for us. We choose our bank here, and EasyEquities has an account with each one of them. And then very important, don't get this reference number wrong. And then you're going to sit and wait for your money, because you typed in the wrong reference number. You have to type it exactly the way it is here, and you will get your money within minutes. Okay, so I wanted to show you guys deposits. I don't recommend you paying with a credit card. So if we go there, so if you pay with the EFT, okay, you are going to, if you deposit 1,000 Rand, it's going to show 1,000 Rand in your EasyEquities account. If you're going to use a credit card, you can also see here what EasyEquities is telling you. This method is immediate, but you will pay 2.3% of the total value of the transaction and a flat fee. Ne? So it really adds up. They're telling you here, this may not seem a lot, but it adds up. So you can pay 230 Rand if you put in 10,000 Rand. It's not worth it. Use the right bank account. You must have a South African bank account. So you choose the right bank and it will show within minutes. Rather be patient. I do not recommend. And you can also see EasyEquities is not really keen. They're not, it's not that they're not keen. They're like telling you, guys, it's really expensive and fees are critical in investing. So that's what I wanted to show you in terms of deposits. And then I want to show you how to do a transfer. So under deposits, it's called inter-account transfers and Easy Forex. Okay, so one thing that I want to tell you guys here is you need to, so okay, kiddies can't invest in the US. Okay, so just be careful of that for the little ones. There are some exchange traded notes I'll show you guys quickly that the kiddies can invest in that will give them US dollar exposure. But then you choose your from account. You can choose, I want to transfer from, so you transfer your money normally to your always to your EasyEquities account from your bank account. You don't have special details for your dollar account. Okay, you transfer it normally to your Rand account, and then you come here and you do a transfer. Okay, so now it will tell you I'm going to transfer from my Rand account to my dollar account. It's telling me this is the exchange rate EasyEquities is going to use, and it's telling me it has a transaction fee of $4.60. So be very careful when you're transferring. There's also you can also, you can see this here at the top, read this article. How much should I transfer to optimize on fees? EasyEquities has made it easy for us. So people, obviously, you don't want to be transferring $50 because you're going to be paying $4.60, which is 10% of your money. You are going to be paying in fees. So you don't want to. EasyEquities has given us a live example here. You can just go and replace the exchange rates with today's exchange rates, and you will see what is the optimal amount to invest to optimize the fees. So they've made it very easy for us. So with that dollar exchange rate, it was 33,000. Okay, so if we now know it's going to be a lot less because the exchange rate is closer to 14. Okay. So if we go, and then all you do is, and then it's very important. I found a trick. So this is not EasyEquities speaking, it's me. People often ask, how long do I have to wait for my money? So they tell you, yeah, it's 48 hours. Somewhere here it says 48 hours. Okay. But I found that if I transfer before 10 o'clock in the morning on a weekday, I get my money by 1 o'clock that day. So before the US markets open. If I do it after 10 o'clock, I get it the next day, 1 o'clock. So I've done these transfers all over the place. So I found that that's the fastest I get my money. Do it before 10 o'clock in the morning. I get it by 1 o'clock, 3:30 the US markets open. I'm ready to buy. Also, the other thing is there is a lockup period. Be very careful, guys. We always say don't invest money that you need. So there's a 40-day lockup. You cannot transfer your $1,000 in here and within the 40 days you want it back. There's exchange controls that needs to be adhered to. So exchange controls is the rules between two countries in terms of currency and how it moves. So EasyEquities cannot give you your money back. No matter how much you scream and shout, you are actually shouting at the Reserve Bank, and there's nothing they can do about that. So if you transfer money to your dollar account, be sure that you don't need that money in 40 days, because we should not be investing money that we need. Okay, so that's the inter-account transfers. And there's easy credits. Easy credits is if you want to have alerts, etc. You want to have a live price update. You can buy easy credits with the money in your account. Your source of funds is, I think everybody's is set to, this is a new account I set up yesterday, so it's not on the screen, but most people have a source of funds of 200,000. What that means is in the tax year, you can only transfer 200,000 into EasyEquities. If you want to transfer more than 200,000, you just need to send them documentation. So I know I had to do that because I sold a few properties and I wanted to invest the money. So all I did was I just sent EasyEquities the proof that, you know, I sold properties, from the letter from the lawyers that says the money is coming to me and they increased my value. So it's not that they are, it's just that they need to manage risk, okay? So the overview of your account is literally what it says. It will show you your account value, etc. It's the same on all your accounts. You can see, you know, how much you have in ETFs. If I was invested in anything, you can see there. And then I want to just show you in terms of buying something. So let's say I've made up my mind now. I'm going to buy Impala. And then I will go in here and I search for Impala. And it's as easy as this. If I have 100 Rand to invest, I would come here, I'd see Impala's share price, I'm happy with it, I put in and I say once off, okay? Or you can make a recurring investment, but you can ask me about that some other time. And then what is the one thing? Oh, on the invest now, a lot of people struggle with this. You cannot, you look for EC10 under shares. It's not a share, it's crypto. Okay, so you have to go to crypto, you won't find it. You can't look for an ETF under equities, won't work. You can't look for an ETN. So this is where I said you can invest for the kiddies in Netflix, PayPal, Tesla, Microsoft. This is where I buy for my daughter, McDonald's, JP Morgan, US companies, but through South African banks, okay? That's a very neat trick to get the kids. And then there's crypto, recently added unit trusts. I don't really do baskets and bundles, so I'm not going to pretend to be an expert there. That is literally it from me. I have taken an hour. Let's take questions.
Thank you so much, Rochelle and Esther, for such an informative webinar. And I can see the comments. Everyone else is just like, this is so insightful. This is so helpful. This is the, you know, information that we've been seeking. So thank you so much, Rochelle and to Esther. I will randomly select the question and I will ask either you, Rochelle, or Esther to answer. Londi says, please can you expand on the government bond and how they work? So in short, Esther, if you can maybe elaborate on what government bonds are and how they work.
I'll keep it very simple. It's basically government trying to raise money by offering bonds from retail investors. So they want to raise money and they do that by offering bonds. So retail investors then can go to National Treasury and buy government bonds, or you can do it through exchange traded funds like I think New Fund Gavi is also part of a bond that you can buy, and they give you interest. I think it's quarterly. I could be wrong. I think it's quarterly. You earn interest off you know, having that bond. I hope that helps.
Awesome. Thank you so much, Esther. And then Edna says, how does one check which company a particular ETF has on their books? My worry is doubling on single shares and on the ETF, investing in the same company twice. I know, Rochelle, I'm not sure if you would like this one.
That one is for Esther. I'm not an ETF investor.
Okay. So I look at the minimum disclosure document, the MDD, just to check what, company, what companies are in the top 10, for example. And then I know, for example, I'm invested in Satric's top 40, and it has got NASPAS. I think NASPAS is the second largest holding, and I still hold NASPAS as an individual stock. So it just depends on you and how much exposure you want to a particular company. But yeah, I usually go to the minimum disclosure document just to check what companies are in that, what that index tracks, what that ETF tracks essentially.
And just a follow-up question. Thank you so much for that, Esther. I know you spoke about small caps and large cap stocks. So don't I want to know, what is the cap for small stocks? In other words, what is the category small cap stocks?
I'll let Rochelle pick that one.
Okay, so small cap stocks on the JSE. Okay, we normally look at. So I'll take both. On the JSE, we look at the JSE has a limit of 500 million. Okay, so you need to be a company that has a balance sheet over 500 million to be invested on the JSE. So we look at small caps as companies that have less than 2 billion on their balance sheet. Okay, and then you get the medium caps, and then you get large caps and mega caps. So if you're using a stock screener, you can literally, you don't have to know the different classifications, but if you click on a company, you will, and if you Google a company, you'll always be able to see at the bottom of that Google graph where you see the share price, you'll be able to see the market cap of the company. If it's under 2 billion, it's most likely that that's a small cap company.
Thank you so much, Rochelle. Esther, you also spoke about asset classes, the different asset classes. And Tabsing wants to know, where can they buy bonds?
So you can go to Treasury's website, the South African Treasury, and you can buy them directly there, or on EasyEquity under exchange traded funds. You can look for, I think it's New Funds Gavi. That's the one that comes to mind now. I know there are others, but my mind is just failing me now. But that's one of the bond ETFs that I can think of right now. You can buy an exchange traded fund that obviously is linked to it's a bond ETF, or you can go to South African National Treasury. I forget the link now, but I'll remember and post it.
Thank you so much, Esther. This can go to either you, Esther, or you, Rochelle. Mantako wants to know, how do you consider whether the stock dividends, the stock or ETF pays dividends?
Okay, so stocks are easy. If a stock pays dividends and you Google the stock, it will have a dividend yield on Google. You can also go to the company's website. Any company's website in the investor section will have a dividend summary. So it will have all the dates of when dividends was last paid, their ex-dividend date, and the payment dates. So if a company is not paying dividends, you will see it also on their financial statements. So if you look at the financial statements of a company and there is no dividend payment on it in the cash flow statement, because the cash flow statement is cash. So you can go to the cash flow statement. If there's no dividend, it means they don't pay dividends. So I start with Google and then I move to the company's financial statements. ETFs is?
I just also wanted to add there, Rochelle, to what you were saying. So also when the company releases its financial statements or, presentation, they'll usually say how they performed and if they're declaring a dividend or not. And then just in terms of your exchange traded funds, on your minimum disclosure document, your MDD, you'll be able to see whether it pays dividends. You'll see there it will say distributions, or a non-distributing ETF. In case of dividends, sometimes I know ETFs pay quarterly, biannually, or semi-annually or annually. Those that don't pay, like for example, your Satrix NASDAQ 100 does not pay. It's a total return ETF, meaning it does not distribute dividends. So what that means is that when after the performance or whatever it tracks has declared a dividend, they reinvest it on your behalf. So what you see is the share price of that exchange traded fund over time going up, as opposed to paying you a dividend.
So much for that, ladies. Rochelle mentioned that you shouldn't invest the money that you need. So without giving advice from your personal perspective or from your journey, Nomsa wants to know what type of account advise to use for an emergency fund.
Okay, so an emergency fund, emergencies, you need the money immediately. I know very few emergencies, where you don't need your money very fast. So I use my Capitec savings account. So if you have a Capitec account, I know a lot of people use Time Bank. I set up, so I have my emergency fund with Capitec, and then I have 2 sub accounts, which are my goal saves for the year. So where I save for December, and then I have another account where I save for my daughter's school fees for the next year. So I want my emergency fund to be available immediately. So if anything, happens, my family lives in Cape Town. So if anything happens and I need to fly to Cape Town, I can't have a 7-day call account or a 32-day call account. And I certainly do not want to sell my shares for an emergency. So ladies, please have your emergency funds. I know you feel like you can earn, bigger money, like returns in the stock market on your emergency fund. But what if the stock market is down when you need that money, and then you need to cash in at a loss? So we don't want to be doing that. We put our emergency funds in savings accounts. We don't use our tax-free ever for an emergency fund, because you lose out on your lifetime benefit of your savings, of your tax-free. So your tax-free should literally be the last place that you cash in, because you want to get the maximum out of your tax-free account.
Thank you so much for that, Rochelle, for that extensive answer. I think that certainly will help. There's an anonymous question. They want to know that the presenters speak as if there's always guaranteed returns on the money that we've invested. Isn't there also a chance to lose that money that we have invested? And how does one save against that?
Okay, I can take that one because I have shares that's currently in a loss position. So I'm not speaking from a hypothetical situation. So I currently have a share in my portfolio, Intrusion. That is one of my biggest investments that you guys saw on the slides. And I think Intrusion is I'm currently at a 17% loss. So I don't set stop losses for growth companies, okay? You can use stop losses. Now, I know EasyEquities doesn't automate stop losses, but you can set alerts and then go in and stop your loss. If you are willing to only lose 10%, I can't tell you what your loss percentage must be. Everybody's different. So if I invest in, let's say I invest in Facebook, and I don't expect Facebook to ever pull back 20%, and then Facebook does pull back 20%, Facebook is not a growth stock anymore. So that's unforgivable. I would most probably cut my losses. I won't hold on. I'll go and buy something else. But Intrusion is a growth company. They have a brand new product that they are building a clientele for. And the stock pulled back based on short reports. So short reports is when people just talk crap about a company without basis. And people then start selling. So with intrusion, I told myself, I'm going to give the company 3 quarters to prove to me that they have this 50,000 brand new clients that's signing on, and it's going to start showing in the revenue. So only when intrusion, if they miss revenue targets, I'm out, because I told myself I'm going to give them 3 quarters. If they prove me wrong, I think I'm right. I believe the CEO and the CFO and the company. But if I'm wrong, I'm going to cut my losses and go buy something else. So stocks don't only go up, guys. They go down, they go up. In the long term, the stock market goes up. So I don't give my stocks a week or a month or 6 months. I literally told myself, for ints, I'm going to give them 3 quarters to prove to me that they can make revenue targets.
Absolutely. And I think that's investing. When we often say that investing is a long-term journey, this is what we mean. Definitely the market goes up and down. Thank you so much for that. So there are a lot of questions and we have a minute. I don't know. I know you guys are still going to share some pointers. You're still going to select the winners for the competition. There's a lot that's going to be happening post the webinar. And thank you so much to everyone who's, been engaging, people that have been participating in the competition, the questions that are flowing in. If we haven't managed to answer everything, jump onto our Twitter page, jump onto Rochelle's Twitter page, jump onto Esther's. It's there on the screen. Just look at what they're saying, follow the Twitter community. They share a lot of information. There are a lot of resources, free resources, the EasyEquities platform, not on Easy, on social media. There's a lot of resources available to you. So they're up there on the screen. Stay tuned on Esther's Twitter page there at Mukumbo for the announcement of the winners. And thank you so much, guys, for making time on a Saturday to join us, for answering the questions. And for those that are wondering if this session will be made available, it will be made available on our YouTube page, on the Equities YouTube page. Alternatively, you can also visit our FAQ section on our website to help answer most of your questions. I don't know if there's anything else that Esther or Rochelle wants to say before we close.
Just thank you to all the ladies that attended. I think, we want to have as many ladies investing. It's not as hard as we think it is. You don't have to pick individual stocks. If you're not comfortable, you can just buy exchange traded funds. I know people that only buy 3 exchange traded funds, and that's all they invest in, and they do get returns. So it's not as hard. If you don't want to be picking individual stocks, look at exchange traded funds, but just start investing. And thank you to each and everyone that took the time out to just spend this Saturday with us. We appreciate you. We saw everyone. I saw the tweets. So thank you, everyone.
Thank you, Esther. And for those that were not aware, we have the Easy podcast. So check that out as well. It's very informative. It will give you all the information that you need. It's part of our resources, our free resources, like our research page, blogs. We have the Easy Academy that you can go through, sign up onto it for free, and basically, just educate to help your investment become a seamless and easy process. From me, thank you so much, Esther and Rochelle, for making the time to, compile such an intensive session, break everything down and give us insight into not only the broad investment space, but also into your own personal investment journeys. We really, really appreciate you. From us at Team Easy, we say thank you.
Thank you. Bye.
To think go on this